Markets are so sensitive to headlines at the moment. How much attention should you be paying to them? Has the age of US exceptionalism ended? And what are the big megatrends that are at play in the bigger picture? And can artificial intelligence lower inflation? These are just some of the questions that I put to Vanguard's Global Chief Economist, Joe Davis. Have a listen. Joe, you've got a few jobs, but one of them is to work out where to invest $1 trillion.
Yes.
How's your quality of sleep going?
Well, it's going well. As an economist, I'm happy to have a job, Tom. but it's a serious responsibility. Again, I think many investors, my obligation, my team's obligation is to say, what is an appropriate strategic allocation, what some would call a benchmark, that you define your success at, that you plan to, not that you may not deviate from that plan on occasion. So that's where we spend a lot of time. So we will assess a portfolio of various assets, stocks, fixed income, other assets, could be real estate, and we ask two questions. One is, what's their expected returns and risks? And then when you put them together, what is the probability of success of those investors, whatever their goals are? So if I'm 35 years old, it's for saving for a house or it's for retirement. And then we'll use a lot of statistical, machinery. But at the end of the day, we're assessing the viability of a portfolio, either that we would construct on behalf of our clients, or to give that information to a financial advisor who's got the fiduciary obligation to do that on behalf of someone, or the individual investor who will assemble ETFs, say a ComSec, and then will do it themselves. So that we give the same information to all three parties, and we hope that's of value in the objectives that people are trying to achieve.
We are often taught to trust the machinery of the share market over the longer term, because when you balance out the noise over a 50-year time frame, that is the important outcome. But what we have seen in the last couple of months are legitimate questions over whether or not the developments are going to interfere with the machinery of the market. Is that a reasonable question?
I think it is. It's certainly reasonable to be modestly concerned about it, Tom. Again, I'm coming here from the United States. The largest equity market in the world. I've come here to Australia. The headlines are the same. Concerns are the same. If there's one solace, it's on two fronts. The first one, although the headlines are alarming, it is headlines, maybe the words are different, but it's headlines such as this in each decade for the past 2 centuries, whether you lived in Australia, the United Kingdom, or the United States, where it was those headlines that actually were one of the reasons why financial markets or equity markets, they were rewarded, investors were rewarded for putting their capital into that risky proposition. Because there's no guarantee that the companies that perhaps you invested, their cash flows were going to endure through the government headlines or the war headlines, or some serious concerns. And so I think that's something that you have to keep in mind. That's what our Vanguard's founder, Jack Bogle, was fond of saying. That does not necessarily mean that past will be prologue, but it's precisely that we can't guarantee that, which is why I would say to everyone that I understand the emotion of reading the headlines. Like, I get this is not easy, which is why you should be compensated with higher returns for deploying your hard-earned money and putting it in there rather than keeping it under the bed mattress. And that is the basics of investing. Because if we could have that stability and then you don't have to worry about the headlines, I shouldn't get as high of a return because I'm putting my hard-earned capital at work. And that is the basic of financial markets the past 300 or 400 years. So, but I'm not here to dismiss the fact that the headlines today can be different and more concerning than perhaps where they were just 2 years ago. But there have been a lot of drastic headlines around the world if you just think about the past 2 centuries.
There's a very influential survey of money managers that is regularly released, and one of the questions that come out of it is, has US exceptionalism ended? And there was a very high response. I think it was like 2/3 said that is the case. is that something that requires a little more consideration in terms of the period that we're in at the moment?
Well, and again, if we think about U.S. exceptionalism with respect to, say, the U.S. equity market, say the S&P 500 or versus, say, the 200 or 300 here in Australia, obviously the U.S. markets have drastically outperformed, whether it was the Mag 7 or the other 493 in the S&P. Our thesis, and it was going back over 2 years, so we were never going to get the turning point, Tom, but our thesis was that there was a timestamp on that exceptionalism in the U.S. financial markets. That there was,
and that basically means that
they were going to outperform. The U.S. was going to outperform, right? And my only concern is that was unlikely to continue at, as far as the horizon can see, because U.S. stocks were becoming more and more expensive relative to their fundamentals, and the fundamentals were strong for technology companies. I'm not picking on technology stocks, but we've talked about in the past. You've talked about on the show. That's the art of investing, is that you should not overly pay for too rosy assumptions, or you're taking on undue risks. And so the burden of proof rises over time. So that's why we're not pessimistic on the United States just to be pessimistic. There was a rationale for it. That's coming home to roost, but that was the center of our outlook for the past 2 years. Now, last year we looked out of touch. This year we look more prescient. But the assessment hasn't changed. So what that tells you, though, I think it's just another reminder, whether there's investors in the U.S. or here in Australia, to diversify your eggs or your holdings outside of simply your own country. And so that remains to be the case.
You have been spending a lot of time working on megatrends lately, and the value of understanding the dynamics behind a megatrend are probably more important today than they have been for a long time, because when you understand the megatrend, you have faith in it, then that's the sort of thing that can help you guide through this sort of period. Is that fair enough?
Yeah, and so we spent a number of years, Tom, of trying to get a better handle on, I would say, primarily 6 big forces, which have always affected mankind and society. One is technology, obviously. It's the demographics of society, aging, population immigration. Third is geopolitical tension. Today it's U.S. and China, but in the past it's been other countries. You think about fiscal debt and deficits, a big issue in the United States increasingly. And then, of course, you have just the globalization. And that's what is in the headlines with tariffs and so forth. And then there's climate change. So we've modeled all of these. All of these are significant. But what it has given us is, I believe, an edge that we will share with all investors, which is we are doing with our work, to think, how do I think about this reasonably so I don't get, I reduce the risk of overreacting to the headlines. Yeah. But there is truth underneath the surface. And I can tell you this, what we're seeing with the tariffs in the United States is a lens into one of the primary scenarios that we have diagnosed beginning 2 years ago. And at the other end of the spectrum is the other primary scenario, which is AI, which is probably the basis of conversation everyone was having just 6 months ago before all the tariff headlines. And so that's why we're looking at everything. And those 6 forces affect everything day to day more than most central bankers appreciate with respect to economic growth, inflation, interest rates, and then the stock market itself, whether it's earnings or the valuations, the euphoria in the market. So it's really important, and we believe we're the first financial institution or organization that has brought all this data to bear, to do this in a data-driven way, to give investors insights of how should I think about where the world may go in a broad sense in the next 3, 5, or 7 years. And so that is what we're bringing to the general public.
I mean, just to unpick a particular aspect of what you've just said in terms of the transformative aspects of AI, in a period where central banks have been fixated on inflation, AI has got the ability to really reduce inflation measurably, which just changes a lot of people's investment theses.
I think so. I think that, so where the heart of our diagnosis is this, and that's for the entire world economy. It's primarily centered in the U.S., but it's not just the U.S. It's Europe, and it's certainly China. That there is a coming tug of war between, on the one side, the pullback in globalization potentially, and the high debt levels that require higher interest rates, which it's not good for growth, and puts pressure up on inflation. So that's the bad path. And that's the other tug of war is yet AI, Tom, could be transformative enough that actually increases automation, which we don't have enough of in aging society, and actually keep prices down. We saw this with the internet and the personal computer in the late 90s. Debt levels were growing, by the way, across the world in the late 90s, but no one was talking about that. And so that is the coming tug of war. Right now, despite the headlines coming from the United States, the odds are tilted towards AI being just transformative enough to keep some of these forces at bay, although it is not a foregone conclusion. I love to say the odds were 10-1. It's like 3-2. So it bears watching, and this does have some risk. It tells you that every forecast from the Federal Reserve and IMF and the RBA, respectfully, they just have low odds of occurring because of this push and pull. Like they're kind of like tectonic plates. They're going to kind of grind to each other. But yes, AI right now is in the lead, despite the troubling headlines around tariffs that we've recently seen.
So any experienced investor always views a catharsis through the lens of an opportunity.
Yes.
We've had a lot of cathartic price action in the markets in the last couple of months. Yep. Is it a time to sort of start peeping out of the bomb shelter yet, or what are the signs that you look for that perhaps that first seismic event is over and it's safe to walk
well
around?
Again, I was very concerned about the froth, particularly in the United States, the markets. I don't think we've dropped, but we have not gotten to the point where there's significant, there's no panic selling to what I can detect.
So we've seen a sell-off of almost 20%.
We're down, but we're still overvalued.
Yep.
So that's not good news.
Right.
So what does that tell you? I would pivot towards, let's think about an investment structure where we don't even have to be good at timing, because at least I won't be. And that is back to this tug of war that's coming. A very serious consideration one could have at the margin. So this gets at your opportunity, Tom, where I don't even have to pick sides in the tug of war. What's an investment strategy that actually does well in both? And that doesn't always happen. There's a good path and there's a not as good path. It is in what's called in the equity market, there's generally two types of companies. If you split any market, there's what's called the technology or growth companies. AI could be in there, tech. And then there's what's called value-based companies. They just don't have a high multiple as growth. And what our research shows that for the next 3, 5, or 7 years, there's a high likelihood that those value type companies, which are not as exciting in the headlines, they tend to be financial based companies, healthcare companies. They will tend to do well in either scenario, and here's why. If AI is a dud, kind of like social media has been for the global economy, we all use it but hasn't done anything for growth. Well, we all know the tech companies are just going to fall more than they currently have. But that's not the reason why you would overvalue this. If you think AI is going to be transformative and you're very bullish on AI, you would still want to invest in these companies. Why? Because these companies are going to use the AI and they're going to become more efficient, much like retailing companies did on the internet in the 90s, and other manufacturers did electricity. Electricity came out. So that's the clear outcome of market history, and that's the opportunity, because these companies have underperformed these companies, growth companies, by 10 percentage points per year over the past decade. We have rarely seen that level of underperformance. So that's actually an exciting area that in one sense it's defensive should AI turn out to be disappointing, yet it's being on the offensive if you think AI is actually very robust. And so that doesn't always happen, but that's what I would be encouraging investors if they want to deviate a little bit from their benchmark.
Joe, without exception, it's always a pleasure to speak to you.
Thank you, Tom.
And thanks very much for joining us for the Executive Series.